them start.
Yes, a few seconds. Here we go. We're live. We are live, I think, across LinkedIn and YouTube now. Hopefully everything's worked. We are one property star down in Paul McGee, but he's just rejoined us. So there we go. Happy Star Wars Day, everybody, and welcome everyone to the live. And my amazing property stars that I've managed to assemble to answer your property questions this evening. I'm going to go through one by one. Bring the people up onto the stage and introduce ourselves, or yourselves, I should say. I guess I'm going to just do it in the order that you guys appear on my right-hand side. Is that all right? So you're up first, Amy, if that's all right. Welcome to Amy, the property tax queen, who at the moment is the most Star Warsy amongst all of us, with her awesome Princess Leia hair. So Amy, I'm just going to drag you in. Say hi to everyone and introduce yourself.
Hi everybody, so my name is Amy Richardson and I am better known as the Property Tax Queen, and yeah, may the 4th be with you. I own an accountancy and tax firm based in the Midlands, and we're here to help landlords and property investors and developers pay less tax. So fire away with your questions.
Awesome. And I should say, as we go through this, guys, if any of you have any questions for any of us, then please put them into the chat. Already got a couple of comments. I see T Changa's already put in a couple of obligatory flame emojis. So thank you very much for that. Next up, the man with the land, Shane Traynor, the All Right Investor. How we doing, buddy? Jump up, introduce yourself.
Very well. I'm very well, thank you. Thanks for inviting me on. So my name is Shane Traynor, aka the All Right Investor, and I'm the business development manager for a property development company called New Home Company. And effectively, it's my job to find land, appraise the land, negotiate on the land, as well as do whatever I can to drive growth in the business.
Awesome. So any questions that any of you guys have got with regards to anything development-wise, Shane's your man, and just sourcing land. The amount of conversations I've had with Shane and just going through his process of how he's finding land is pretty awesome. So anyone out there that wants to discuss anything development wise, chuck a little comment or a question in the comments and we'll be good to go. But Radhika Shah, you are up, the lady with the superhero name, as I say. Radhika, introduce yourself to everyone.
Hey everyone, my name is Radhika. You pretty much introduced me, but I've been investing for 4 years. Started off in the HMO market, now kind of slowly moving into the buy-to-let market. So I also work full-time, if that's helpful for anyone that is watching, because I do a bit of both. So yeah.
Yeah, very, very difficult to be in this market, in particular, investing in property and also have a full-time job. So kudos to Radhika for that. Last but by no means least, the sexiest man in property, Mr. Paul McGee. How we doing, buddy?
Did you not say that about me?
I can't say you're the sexiest guy in property, Radhika. Okay, that would just be
no, not me, Shane.
Oh, Shane. No, he's got the best hair in property.
I'll take that.
He's sexy from the forehead up, and as we know, Paul is sexy from the forehead down. So there we go. Paul, jump on, introduce yourself.
Cheers, mate. Yeah, thanks for that introduction. So yeah, I currently work. You guys know me anyway from Forex trading, but I also work full time now. I had to go back to it because I've missed property over the last year. I work as a property broker selling ready-made HMOs and blocks of apartments across the UK. So working with high net worth individuals who largely want to park their cash with ready-made, ready set up HMOs, so they're earning from day one. Previously, I used to source properties across the whole of the Northwest really quite successfully, grew a strong, somehow personal brand where, I don't know, ended up with one of the largest investor lists probably in the UK for sources. So yeah, thank you for having me on. I feel like the most inexperienced one here.
Not at all. I can definitely vouch for Paul in terms of that that investor list, because you and I seem to have daily conversations at the moment, Paul, in terms of discussing sites and whatnot. So I'll quickly introduce myself as well. My name's Sam. I am the owner and director of Grand Union Finance. So we are a finance brokerage that specialise in helping property investors and developers raise funding. So if any of you guys have got any funding related questions or any finance related questions, anything from mortgages, bridging, development finance, commercial mortgages, etc., please chuck them into the comments, and I'll certainly jump on and answer any of those. Now, I was gonna, well, we can make a decision on this, guys. I was going to ask the question just in general about how you guys are feeling about the market at the moment. It's a bit of a weird one. We have got a question already that Sue and Claire have asked in the comments, directed, I imagine, at Amy, all about sort of arranging LLPs / limited companies. We can come on to that in a second. If you guys anyone want to sort of jump in and give their sort of initial opinion on how they're feeling about the market at the moment.
I feel like throwing my laptop out the window on a daily basis.
Is that just because you're struggling to find sites and stuff at the moment, mate?
Well, sites is okay because sites it's come into me at the moment because I've built some good relationships with some land and new homes. But I get I do a lot of sourcing for properties as well for the MD for his own personal portfolio, and I'm finding just how bonkers the property market is at the moment, with people paying well over above what the property's worth. And I've had a chat with probably 6 agents over the course of about 6 weeks now, let's say, and I've just asked them the same question, say, like, when people or potential buyers are putting in offers for houses and you know they're going to get downvalued, do you tell them that they're going to get downvalued? And their answer was, a few of them were like, yeah. A few of them was like, yeah, sometimes we do. And we just we hope that the valuers will accept it and they'll get the lending on it. And I'm like, well, that's outrageous, because what happens is when it gets downvalued and it comes back on the market, what happens is it goes to the next highest buyer, which is still higher than what it's valued at. And it's wrong what's happening. And it's like, but as an investor, don't get me wrong, there's still deals out there. You can still find them, but it's has become a lot harder, I've found. And it's agents, I'm finding, not every agent, this isn't saying every agent's bad, but they need to start educating the vendors a bit and telling them, like, that offer's a bit too high, and saying to the owner of the properties as well, and say, like, look, we can't market it at this level because it's going to get downvalued, which is going to take longer to sell it. So that's sort of my 2 cents.
Do you know what? I can jump in on that, actually, because one thing that I've obviously noted I see it from my side, because I'm working with clients that are buying properties, and then we're getting to valuation stage, and I'm basically saying at the moment, between what an agent is saying a property's worth to what a surveyor is saying a property's worth, at the moment it's probably like a 5 to 10% gap. In some instances, a lot more. And the reason why that happens is because we're in such an upward trending market, and because the transaction numbers up until probably the last couple of months have been so bloody high. What's happening is we're seeing that by the time the sales are then going through, the valuers are looking back in time. They're looking at what has already sold. But unfortunately, some of the sales that have happened, in the last few weeks and maybe even a couple of months aren't actually on land registry yet. So there's such a massive disparity in such an upward trending market. And that, I think that's where we're seeing that issue when it comes to valuations and stuff like that. Anyone else got any thoughts on the market, or is Shane pretty much made us all feel shit? Go on, Radhika.
I'll jump in, but it's exactly what you both have said. There's a massive disconnect between the expectations of what a vendor is wanting to sell at compared to what the valuers are. And looking back at data, when we were going through the refinance on the buy to let, it doesn't really matter what anyone else values this, whatever else is on the market. So if someone's desperately trying to sell, they're going to put it on at whatever they think is a fair offer. But then if valuers are already seeing, okay, the market's already 5 or 10% higher, then they're just automatically going to downvalue each and other property, even if that one's a fair valuation of that particular property, which is where the disconnect happens. Is where is the truth? Are people just where is the overpricing being taken from? Is it from a fair offer, or is it from people wanting to buy properties and investing and parking their money in? So yeah, that's my 2 cents, and there's no real clear definition of what it is.
Yeah, I know it's a tough market at the moment, and I mean, Paul, you were obviously saying before that you've obviously got quite a lot of investors at the moment, and you're up and down the country looking for property. In terms of how you're finding deals at the moment in quite a tricky market, how are you kind of finding things?
Yeah, the deals come to me, which is quite lucky. But if I was out starting again from scratch, I would see it as quite a difficult market. I think, generally speaking, once you get your head around the fact that it's a supply and demand feed at the moment, and it's fear and greed, there is a disconnect, I believe, with valuers. So, mortgage lenders, things like that. Generally speaking, you're finding that investors are paying a top up. So a bit of a gap between the lendable value of a property and how much the market perceives the property to be worth. Okay, so like to give you a basic example, let's say that the vendor and the general market believe that a property is worth 100,000 on the market. The lender may come in and say we're only willing to lend up to 80,000, which means that there's going to be a 20,000 gap, which is usually paid for a top up straight to the vendor. So the actual buyer is paying not just the deposit of the mortgage, which in that case would be 20 grand. They're also paying an additional 20 grand on top. But the thing is when you look at the market cycle, so property market potentially as well, but general market cycles, is that when you get something like this, a lot of people consider it as a bit of a spike. But the truth is that the new market value is today's market value. It's, the lenders need to catch up. And that's generally, from my understanding, what's happened in the past. It's not a case of property going to crash all the way down to where we think is acceptable. It's down to where the lenders are going to catch it. And it's probably going to be higher than what most people are expecting. So, the whole economy of the UK is built on property. So if there are people there looking to buy investment properties and they're looking to pay over the odds in accordance to what a lender would perceive, it's going to continue to grow.
Yeah, do you know what? It's funny actually, because I was talking to somebody recently about this, that I do a lot of refinancing sort of post refurb work, and lenders obviously we've had this kind of like weird invisible 6-month rule for a while, so you can't refinance a property before it's reached 6 months worth of ownership, particularly not at open market value, and there's a select number of lenders that will do it. What amazes me still is, and this is how lenders will say the market is the market effectively, which is like their get out of jail free card for everything, is that if the property has been bought genuinely below market value, and there are reasons why a property might be bought genuinely below market value, they won't revalue it at open market value unless they can actually see proof of work being done. And I've never understood this. It's the easiest thing in the world. You just send a RICS qualified surveyor to the property and tell them to give it an open market value in the current market. It's as simple as that. And I just don't personally understand that myself. And it's similar to what you were saying, Paul, in terms of, there's just this disconnect at the moment. I do think that we're possibly 1, maybe 2 base rate rises away from mortgage rates being enough to tip the scale a little bit, not in favor of buyers, because that won't ever happen, but you know what I mean. Just be enough to reduce the available credit down just that little bit that will maybe stabilize the market a little bit. I'm conscious of the fact that we haven't come to our Princess Leia lookalike, Amy Richardson, yet for her opinion of the market. Did you want to chime in, Amy? Or I do have a question that has been put in our comments for you specifically, if you wanted to answer that instead.
Yeah, I mean, just chipping in on the market side of things. So a lot of our clients now, especially the property deal sourcing clients, they are, well, the one guy said to me, most of the deals that he's sourcing, they are at market value. There doesn't really exist at the moment below market value. So he's kind of pitching to investors with that in mind. So it's very obvious that that's the kind of issue that everyone's facing at the moment, and it's a case of buy something, if it's buy to let, buy something that doesn't need a lot of work and it's kind of off the shelf, and what your ROI is, etc. But yeah, there doesn't seem to be a lot of opportunity for good deals at the moment, and in particular flips. I see a lot of people struggling to get flips as well. So yeah, it's a funny old business, isn't it? But going on to LLP or limited company for service accommodation then. So I guess let's start by saying, so an LLP, for anyone listening, is a limited liability partnership, and limited company is a completely separate legal entity. Now, when it comes to serviced accommodation, actually there's less incentive to become a limited company and push it through there. Whereas buy-to-let, you can't reclaim the mortgage interest in your own name, and then that's basically why everyone puts them into a limited company these days. Well, actually, with serviced accommodation, as long as it fits the furnished holiday let rules, then there's less incentive to actually go limited with that business idea. And the fact that you've got an LLP and a limited company and service accommodation means that you can claim the capital allowances. Now, in some instances, it is better to have an LLP and claim the capital allowances for some clients. And in some cases, a limited company is a better structure because there's other deciding factors that tip it that way for them. But yeah, I guess from a tax perspective, an LLP is treated completely different to a limited company. So an LLP is taxed transparently. So even though it's a partnership, actually it's taxed on the individuals. So if you have a higher rate taxpayer and a basic rate taxpayer, you can construct that partnership to the appropriate partnership apportionment levels so that you pay less tax overall. However, you can still achieve the same result in a limited company by putting in a bespoke share structure. So it's unfortunately in tax, the answer is it depends, and it depends on what the client's goals are, what they're trying to achieve, and what their current status is. So are they both basic rate taxpayers? Are they both high rate taxpayers? Have they already got property? Have they got commercial property? Do they just want to do serviced accommodation? Is it only one serviced accommodation they want to do? Is there multiple? So you can see that with all these different factors coming into play, depends on what the answer is for that client. But specifically for serviced accommodation, it's not going to make too much difference in terms of, you know, the P&L side of it, so the profit and loss side. Whereas if it was a buy-to-let on the tax side, then that's when you would most likely put the properties in a limited company if you're a high rate taxpayer. So I hope that helped. Yeah,
interesting stuff. Can I ask? I'm interested in. I want to ask this question because I know what I say to my clients. Now, obviously, I always have to say to my clients, I'm not a tax advisor. Always have to chuck in the little line. It's my understanding that before I say anything tax wise. But one thing I talk to my clients a lot about is when should they potentially incorporate, if they do at all? Is there like a sort of a hard and fast rule about this is the time to incorporate your portfolio? And on the back of that as well, how hard is it when you already have a property in your personal name to then incorporate it? I'm interested in your thoughts on those two things.
Well, considering my battery's about to die, my laptop, my charger broke, I'll try and do this very, very quickly.
Okay, if we leave, we'll have to move on to something very quickly.
I'll try and rejoin my phone if it does go. So why would you use a limited company in the first place? Well, the first port of call, as mentioned, is if you're a high rate taxpayer and you've never invested in property before, but you're deciding to do it now, then it makes sense to use a limited company because you're going to pay less tax overall, because something called Section 24 came in years ago, whereas you used to be able to claim the mortgage interest in your own name, but you can't do that anymore. So it's more beneficial to put into a limited company. Other reasons why you might use a limited company, for example, if you want to grow a massive property empire, then you're going to be way better off starting off in a limited company, because in my view, you should always start with the end in mind. So if you just want a couple of properties, 2 to 3, maximum 5 buy-to-lets, you're a basic rate taxpayer, don't even bother, just keep it in your own name. But if you're a high rate taxpayer, you want, quite a big property empire, then you really should look at a limited company. And there's advantages to that limited company in the sense of you choose when you pay that tax. So you choose when you want to withdraw a dividend. If you decide you don't want to do that and you just put the buy-to-lets in, let the cash build up, you can then purchase more property without having to pay double tax. And what I mean by double tax is you've paid corporation tax in the limited company vehicle, currently 19%, due to go up to 25%, but that's a story for a different day. So you've paid that tax already. So actually, if you wanted to withdraw the money, then you'd have to pay income tax. But if you're going to invest in more property, you don't need to withdraw the money. You've already got in the business, so you can recycle that money a lot quicker and grow your portfolio a lot faster by using a limited company. If you did it in your own name and your profits start to creep up into the higher rate tax bracket, you're paying tax at 40, 45% in some cases. Effective rate of tax for some high rate taxpayers because of Section 24 or buy-to-let tax. We've seen it anywhere north of 100% just because of the way the calculations work out. So it definitely pays to put in a limited company if that's your situation. If you've already got a property portfolio, and I mean a substantial portfolio, and that is all that you do, so you run it as a property business legitimately, i.e. you spend more than 20 hours a week, you meet other criteria, there's some tax legislation that says actually, so if for example you did the partnership to limited company route, then there's potential to do that transfer of properties without paying SDLT or triggering capital gains tax. Now, in reality, that is quite difficult to do. If you have one property, a couple of buy-to-lets, and you've got a day job, then it probably doesn't make sense to transfer those properties into a limited company because you will trigger off SDLT and CGT, and it becomes expensive. And what I always say to clients is, it's great you're going to save tax, for example, but also speak to your lawyer, speak to your mortgage advisor, because there's all of the refinancing costs and everything else that comes into play. So it is doable, but I think a lot of people think it's super easy, but it's not. And we have to, when we're looking at a client case, we literally have to get all the facts around us, apply that to the legislation to come out with a likely answer of, what we think is possible. So yeah, again, it's not a clear answer. It is doable, but you have to be very strong if you come up against HMRC, if they challenge anything on that front.
I guess the answer to the question really is it's very much down to personal circumstances, right, Amy?
Yeah, it's like anything in tax. There's never a one size fits all. So what maybe, yes, you can incorporate and potentially not pay SDLT and potentially not pay CGT for one client could be an astounding no for another, and it's purely based on that. So how many properties are they actually working in the business? Is there somebody else involved? There's all these different factors that actually play into that part, and as to whether it's actually doable for that client or not. And like I said, always speak to your mortgage advisor and everybody else involved in that transaction, because it is costly. Sometimes we get cases where a client, it makes sense for them to pay the little bit of tax of the SDLT or the CGT to just get them in, because actually over the long term, the cost benefit analysis says, yeah, okay, it's more of a benefit for me to pay the tax now and recuperate it in the future. But yeah, it is always down to client circumstances, more than likely.
Awesome. And you didn't run out of battery, so that was also an added benefit. So cheers for that, Amy. Thanks for answering the question from Sue and Claire in the comments as well. So quickly before we carry on, we all of us have sort of put question boxes in our stories over on Instagram. Did anyone get any questions that they wanted to bring to the table, apart from asking whether Paul has OnlyFans, of course, which was the first question that I received.
I did get a legit one. Did get one legit one.
Well, look,
I did.
Look, come to the stage. Ask. We shall provide answers.
We shall. Cool. Okay. So this came in from Ryan Taylor from RMT Properties, and he put, would you rather sacrifice some profit with a deal or stick to your guns for the 15 to 20%? And my view on that is I'd rather sacrifice the deal. And my reason for that is because anything less than 20% on a development is too risky, in my opinion. And not just that, the fact that you need 20% in the profit for a lender to even, if you are going down the institutional finance route, for a lender to even give you lending, development finance and all that sort of stuff. So I would, I'd negotiate the offer for it to work for me at a minimum of 20%. But, you know, if anything goes wrong, like there's a downturn in the market, or, you know, material hikes at the moment, the costs are going insane. That's going to eat into your profit very quickly. Now, you know, buying properties can be a relatively safer game. Like, you know, you hold for the long term, and, you know, you can go through market just by holding on to them if you do it correctly and safely. But with developments, if you don't calculate them correctly, they can either make you or break you. You know, so many developers go bankrupt. It's insane. So yeah, I would pass on the deal. That'd be my answer.
Cool. I'm interested to get Radhika's view on this, actually, because obviously you guys are kind of opposite ends, really, because you're doing the development stuff, Shane, and you're a portfolio builder, Radhika. So what's your kind of thoughts on that?
What was the first bit? I missed the first bit.
Go on, Shane. I'll let you reread it.
You asleep, Radhika?
No, I was trying to listen, but
So what was it? What was the question, or what was my answer to the question?
No, what was the question? I heard your answer, and then
cool. So the question was: would you rather sacrifice some profit with a deal that you find, or stick to your guns for the 15-20%?
I don't know if I'm being stupid, but I don't really understand the first bit. Like, would you mean sacrifice the profit, as in like not go with the deal?
Yeah, like sacrifice, like basically go out with like 10% profit. Which, what would you do? 10% on a development? You'd want a minimum 20%, right?
It really depends, like, on what the situation is and where you are in the property market. If it's in a situation like this, then I probably would look at it and figure out, like, is the 15-20% going to be better than not having a deal for like the next 6 months? Like, how much capital is involved? Where is my positioning? How much access do I have to finance? And so, like, all of those combined, I probably would look at it for a buy-to-let, or maybe not HMO, but yeah, definitely for a buy-to-let, especially within this market. But it kind of just all stacks to kind of, you know, what the lending is against it, how much deposit is it really worth, can I put my money into something else that's going to give me 15-20%, or do I want to kind of stick it into a property? Sorry, that was such a fluffy answer, but like there's so many factors involved.
Do you know what? Yeah, I was gonna say something really similar to that. Yeah. That I get so many clients that so I'll jump back in. I have so many clients that just they always find a reason to not do that deal. It's almost like sometimes they're scared, especially newbies that are that first 1-2 properties. They're looking for the perfect deal, and especially in this market, you to a certain extent, I don't know if you agree, Radhika, you kind of almost have to take what you can get. You either make a decision to go for it and work with the market, or take a little bit of a sabbatical. Is that kind of what you were getting at?
Can I add one more thing? Sorry. I think
100%.
Just something that you just said is we constantly compare our deals to everyone on social media. So whatever numbers they're putting on, whether it's inflated or not inflated, as a newbie investor, you're never going to get good as deals of people who've been in this game for like 10, 15 years, or even if like the last 3 years, you're just not going to be as good as them in finding deals or what your current situation is. So we're constantly comparing our numbers and be like, okay, maybe like 15% isn't good because someone else is getting 45% that they've put, but in reality, you don't even know what the truth is. So I think you need to assess your situation. Is it what are you going to do without this deal? Like, is there something else in your pipeline that's going to replace that deal, or are you just going to sit there and kind of like say this on every single deal that you're going to have come through and waste everyone's time?
Makes perfect sense. I was going to ask Paul to jump in as well, because obviously, Paul, you're analysing deals like every day, and you're talking to multiple investors on a daily basis. How are you finding in terms of your investors viewing some of the deals that you're putting in front of them? Are they being realistic, or are they actually going, do you know what, the market is pretty crap at the moment, let's take what we can get?
Yeah, I think from the last maybe few days where I've spoken to probably about 100 investors, I think generally speaking, the guys who I speak to, in particularly at the Property Advantage, have their head on their shoulders correctly. Like, they can see the value in the deal, so they're looking to park their cash in the deal. Going back maybe a year ago, when I was still doing the single let sourcing for myself, I could see so much of a difference between certain investors where their fear was coming in. So they were anticipating a drop in the market 2 years ago when we had COVID hit. And then they were anticipating a drop in the market last year when we'd come out of COVID. Now, other people in the single let areas, which I still dabble into, are anticipating a drop in the market. And they're all just sat on the sidelines, picking up nothing, while the big boys step in and take everything and drive the price up even further. So it's literally the more experienced investors tend to just get stuck in and understand this is just part of a cycle. It's part of, like, it's almost like averaging down into a market. So yeah, it really does depend who you're talking to, but where I'm dealing largely with HMO buyers and basically people looking at larger portfolios, looking in the millions, they're not fussed really. It's like, oh, what's the yield at the moment? Oh, it's 8.5%. Last year I could have got 9.5%. But they're not saying, like, you know what, I'm going to put it into a cash ISA. They're still going for it. And that's, personally, I think the best thing to do. Just keep going. At some point, it might be in the future, you might be able to get a 17% yield. I can't say if it's a good idea or not, but you just keep buying. Just buy. If the opportunity's there, go get it. Or pass up and let someone else profit from it. If it's going to make profit, do it.
Do you know what? Raj is actually, our good friend Raj is watching. Hey Raj, how we doing? She's made a really good comment on what Radhika said, which is actually that in terms of how the market is, if your strategy is to buy and hold, and you're looking at long term, cash flowing portfolios, then actually, if you're not making a yield right this very second, does it really matter, because you're holding for the long term anyway, right? So I'm guessing, obviously I know I've spoken to quite a few of your clients, Paul, so I know that a lot of them are looking for the long term. So I guess, the comment Raj has made there is pretty much spot on, right?
Yeah, I would certainly say so. I certainly agree with that as well. It's, at the end of the day with property, like, generally property is a long-term game. If you're in it for short term, like, it's the same if you dabble in the stock market. If you're in there for the short term, you get burnt fingers, so just remember, it's a long-term investment. The only instance where I would caveat that, actually, my whole answer is that if I have several opportunities on the table at the same time for the same price, but then there's all the varying factors of where's it going to be, what's the demand like, and so on and so forth. But in reality, supply and demand is what drives the market. Doesn't matter what market it is. In this case, we're talking property. It's supply and demand. It's fear and greed. Sorry, I just saw another one of the questions on there as well about the reason for the disconnect, and then we kind of went past it. And then, would you mind?
Yeah, I was gonna sort of bring that up. But I thought it might be sort of circling back to what we were discussing before. But yeah, jump in, mate.
It kind of coincides with what I was just saying then about fear and greed. Look at what's happening in the world at the moment. We've had the coronavirus situation. We've got, I think, less people looking to move for work. There's a lot more uncertainty. We've got the war going on, which could potentially get absolutely massive. When there's less people looking to move, there's less stock available. So there's less supply in the market, but the demand is bigger than ever, because our rates, which we get in the UK, are much better than what you get in China. They're much better than what you get in, well, pretty much everywhere else. We are still the safe haven for investments. So there's so much foreign investment coming into the UK. There's so much, like, British investment as well, where people are diverting money from their businesses into property. I'm seeing that happen all the time, but it's fear and greed. There's less availability on the market, which means that when there's a lack of supply, the demand is just forever going to grow. And when there's more demand, there's more price. One day, if we ever come into a situation where there's too much supply, that's when prices start to go down. But I don't see that happening anytime soon, because we're going to have to divert our money into the war.
Circling back a little bit onto what something you said previously, actually, Paul, which has just popped into my head, which is you were talking a little bit about I'll jump back up on. You were talking a little bit about the how kind of the rich, if you like, even in this kind of market, they're kind of not getting that bothered about the difference in 1 or 2 or 3% in terms of return on investment or a yield or something like that. It got me to thinking about how the rich invest as a sort of a differentiator to how not the poor invest, but the kind of like the newbie kind of course educated type portfolio builders go about thinking about things. As you've actually got, I mean, I say all the time, if you look down the Times Rich list, 90% of the people that are on there are there because of real estate and because they've parked money in real estate. They're famous for growing a business or having some kind of other income stream, but they take that money and they park it long term into real estate, which is ultimately why they end up on the Times Rich list. So could we, or could the many of the people watching this learn from the rich that actually the best thing to do is to think long term? Don't worry about the 1% here, the 2% there. It's actually more about just stockpiling something that is ultimately, we know, on average going to double every 7 to 10 years in value, as well as actually making us some money. And I can see Radhika waving her hand down there, so I'll bring you up.
I don't know why I was trying to do it on my laptop. Like just something that you guys reminded me of is like when we were trying to sell the HMO, like we were getting like high-end offers because people just wanted to park their money in. They weren't looking at whether this is the right strategy for people like us or compared to like the richest of the rich. You just using it as a cash offer. They were going to put in a cash offer until they can afford to get lending or whenever the banks want to lend it. So even if they are like, and this is where the greed and things like that come from, they need somewhere to park their money. So they would just come in with cash offers. And for people like us who have to like, or for people like me who have to leverage on banks and things like that and to get lending and mortgages and things like that, I don't have that opportunity to be flexible. Whereas I think some of these cash investors who are looking to park their money, they can be flexible. They can put in a few more £1,000 compared to me where I'm going to have to fork out that money. So I think there might maybe a slight disconnect there in terms of like Paul saying like the greed side, because they just need someone to park their money.
Do you think off the back of that, Radhika, that actually a bigger, like a maybe better investment strategy is actually not to be super focused on just the property side, like many of the course educators talk about, and actually maybe look at creating sources of income that you can then put into buying the long-term income generating assets? Very sort of Rich Dad Poor Dad-esque, if you like. Yeah,
I think it really depends what you do in property. Like my strategy is not a get rich quick scheme, whereas someone who, I'm just going to throw it out there, but like this is not true at all, this is just my opinion, but someone who's looking at like the sourcing side where they're kind of building up like the sourcing side on a high level, not just buying 100k property or not sourcing 100k property, but I'm talking about 500,000 to 1 million, 2 million, etc. Those people who are looking to get not quick rich schemes, but compared to buying and holding for the long term, like their strategies are very much different to what my strategy is. And even on the flip side as well. So for me, it's about parking my money in the little money that I have is parking it into a property where I know over time it's going to be. And so in the meantime, and which is why I haven't really bought anything in like the last couple of months or even looked at property in the last couple of months, because I'm like, how else can I make money where I can just be like, okay, and this might be the wrong strategy and I'm probably going to get loads of people coming after me about this comment, but how else can I generate quick amount of deposit to put into a property where I know I can go to certain places and I can get something for like between 20 and 30k as a deposit and park my money in that way. And I'm not doing it as like, I'm going to work really hard and save. I'm trying to find other streams of income to help me get to that 20k quicker, whether it's through an investor or something that I've created on my own, but creating a business that's going to allow me to have massive amounts of money. So yeah.
You said the word investor. What's your thoughts on using a private investor or maybe even a JV partner? Is it something that you've actually done before yourself?
Yeah, and I think this is a fear in my head because I absolutely like it's a like what's the word, like bittersweet. That's what I was trying to like sometimes, like, yes, absolutely, I'm trying to help someone, but it's not as easy as everyone says it is to be. There's a lot you have to prove. You got to justify your credibility, your trust within someone. Are you investable? Like, if you spoke to me 3 years ago, I wasn't someone that you would want to invest in. I didn't really have anything to invest in. Like, you wouldn't want to invest in me. But over time, like, I have become investable, and people do reach out to me and asking for investment. But I'm very picky and kind of like wanting to figure out, what is the best option. I don't want to work with everyone. So I'm quite fortunate that I can just be really super picky, but they do help accelerate your portfolio as long as you have an understanding, and you can definitely pay their money back, especially within this market. And I think it's so easy to throw out there. Sorry, I'm saying like a million and one things, but right now in this market, you've got to think about how to pay your investor back, because if you get a down valuation, where is that extra 10, 20, 30, 50K going to come from?
Yeah, and I know that there's a lot of people out there that will have a sort of a hybrid strategy, if you like, where they'll flip properties to pay their investors back to allow them to, take the lower ROI deals that Paul was talking about earlier on, or Shane was talking about earlier on, because they don't have that issue in terms of paying their investors back. Shane, I know you kind of kicked off this question, but did you have anything you wanted to circle back and add to it?
In terms of the investors or the profit?
Yeah. Jump on in terms of talking about investors. I know that obviously in terms of what you do within the New Homes Group, it's not necessarily your job to go out and find investors and stuff. But is it something that you and your business partners and stuff have utilised in the past?
Yeah, so that is actually part of one of my roles, is to find investment.
Is it? Sorry. It turns out I did zero homework for this.
All right, just one of my many skills as a Jedi. We use investors on. So the barn conversion we're currently doing, we've used 2 investors. My MD has put in some of his own money, and also the 2 investors have put their own money in, and it's split 3 ways. And it's done on a sort of like a joint venture basis, within an SPV. And we are open to doing more like on like an interest rate, but we're of the idea of let's give more of a reward to people that want to give some money to investment. So we're happy to share the pie, if you will. We're happy to do that because, and the people that we're meeting at, we set up the developers network, and that was one of the reasons as well, was to get investment in our
plug.
Yeah, developers network. We haven't done it in an interest way yet, but definitely a joint venture equity way, and it seems to work, and people are happy with the returns. Because, and if you put money in yourself as well, and at the end of the project you wasn't getting as much investment as you would like, at least you've all got that to deal with, and it's not just you don't have to worry about that to a degree, because you've also put your own money in, so they can see that you're sharing the less profit or the loss or the break even or the win.
Yeah, do you know what? It's funny because you mentioned earlier on in terms of analysing deals. I'll jump back in. You were talking about analysing deals earlier on, and institutional funders wanting to see a certain amount of profit margin to make sure that the deal is worthwhile. It's the same, basically, is the same sort of thing that we're discussing there, is just making the whole thing kind of stack up. But on the flip side, as you said, institutional lenders, as much as investors, they take a little bit of comfort in you putting your own skin in the game. It's incredible, actually, how many I do a lot of development finance, and how many development finance lenders that you think will be pretty flexible, that if you show that you're not putting not one single penny in yourself, actually don't want to do the deal. So if you're borrowing 70% of GDV or something on a development finance deal, and then the remainder of whatever you need to put in and deposit or whatever it might be is coming from a separate investor that isn't a JV partner, actually some of these lenders will just say, well, no, because we're putting skin in the game, they're putting skin in the game, where's your skin in the game? And that can actually cause a problem as well.
100%.
Cool. So look, before we move on, we've only got about 15 minutes left. This has gone really, really quickly for what it has for me. I don't know if you guys have thought the same. Just to say to anyone watching, if you do have any questions that you want to ask any of us, just drop them in the comments, and I'll pick them out, and we can answer them as we go. Also, of course, don't forget to follow everyone on Instagram. All the different handles should be running across the bottom of the screen, all just like magic. As I say it, I've got a quick kind of question, which I know is a real kind of like open-ended. Everyone's asking these questions. This is like the kind of thing that gets asked at the beginning of a year, and we're kind of halfway through. But property strategies at the moment, everyone's talking about buy-to-let is dead. Everyone's saying HMO's dead because you now can't buy HMOs anywhere because of Article 4. What are we seeing as like popular kind of left field strategies that have coming about at the moment that maybe weren't there 2-3 years ago that you think are going to be pretty successful over the next 12-18 months or so? Anyone want to chime in?
Oh, sorry. I was going to say.
Go on, Amy.
Yeah, so I have seen an increase in buy-to-let landlords converting their properties into SA, so converting them into a furnished holiday let or serviced accommodation. A lot of it is tax driven as well, but from a commercial standpoint, the profit that you can make from serviced accommodation units compared to a buy-to-let is, in some cases astronomical, depending on where it is in the UK. So I've definitely seen a lot more serviced accommodation, even rent-to-rent serviced accommodation clients coming on in the past 6 months or so. And then the rest of them tend to be portfolio landlords. But even out of the portfolio landlords, there are a couple that have seen the opportunity to convert their buy-to-lets into SA. So I've definitely seen a hike on that side. I'm not sure if you see that on the investor side. If anyone could add comments to that.
I know you jumped in straight away, Paul, didn't you?
I was literally just about to say SA. 2 years ago, when it was the start of the lockdown, I said to everybody, get into SA. If you're involved in property, get in SA, because we're not going to be going abroad. We're finding out ourselves, aren't we, Sam, Shane? We're trying to book a place to stay in Cardiff in a couple of weeks. So if anyone's got an SA unit in Cardiff going relatively cheap, in 2 weekends time, we'll book it. But it's literally a case of...
we'll do an Instagram live in there and promote your SA for you.
But yeah, pretty much. I've just noticed the comments box as well, by the way. So we literally just had something in there from Raj saying commercial to resi. Like exactly, I think SA short term, commercial to resi is literally medium longer term. Like you've got to think realistically with property. Like I said before, property is a long term game. Short term, for sure, SA is going to help you massively with commercial to resi, and then the resi can turn into SA at least for a short term, then back to standard residential. Cool, you've got something which is really, really long term. Look at the places where other people aren't. Just be smart.
Do you know I'm desperate to do a commercial to resi. I'm desperate to do one with Shane. I keep telling Shane, one day me and you are going to do a commercial to resi conversion. I love funding them. I like finding the finance for them because they're actually surprisingly not so easy to fund. They are so I actually lived for a short time in a commercial to resi conversion in North London in Barnet. And it was
that when you were squatting?
That's when I was squatting. Yeah, that's it. Yeah, thanks for that, mate. No, it was one thing I noticed though. So this is one of the reasons why a lot of lenders quite like this type of strategy is that the commercial. I'm sure I'm right in this. If someone in the comments wants to tell me, wants to correct me, the sort of the level of kind of things like insulation and utilities and whatnot for commercial buildings is actually the standard has to be very, very high. So when I lived in one of these, I think I lived there for about 14 months. I turned my heating on once the entire time I was there. It was incredibly well insulated. So these types of offices particularly are actually, they're absolutely amazing for converting, and actually they don't cost as much as maybe converting some other types of buildings. But the one thing that I'll say as well is actually a lot of my clients are actually doing this and they're holding those properties, whereas before they would kind of be built to sell. Whereas I think a lot of people now are building to hold. Represents its own potential issues because we've then got to find onward lenders at the end to refinance the whole thing. But yeah, I agree with Raj. I love commercial to resi. But anyone else got any other kind of strategies they want to discuss, or jump in on the commercial to resi stuff or the SA stuff?
It's got planning gain as well, which is it's not like a cash flow. I totally agree with what you said, Paul, in terms of the you stop something for cash flow is SA, what Amy said and yourself. But a slightly different strategy, which not many people are doing, is like planning gain. So finding something, it could even be a planning gain to a commercial to residential conversion. So finding buildings, disused offices, and like, because you've got permitted development rights where you don't necessarily need planning, it's just prior approval, 56 days notice to the council. Obviously, there is some certain things go through okay. But yeah, you can just get planning gain on it, or do an option with the owner of the building, get planning gain, and then sell it to a developer with the option and the planning gain, and get a good fee for it. And that's happening a lot, and people are making large chunks of cash at the moment doing that.
Do you know, it's funny that you bring that up, because I was talking to somebody a couple of months ago at the Developers Network in Birmingham, which is where you co-host with Steve, and what they do is they're quite good in the agricultural community, and they're getting options on agricultural lands. They're removing the agricultural ties, which, as we know, is quite problematic. They're then splitting the site down into smaller chunks, sometimes getting the planning, sometimes not, and then doing the basics like getting the utilities in and that sort of stuff, and then selling those sites. And they talked me through some of their numbers, and they were absolutely astronomical. That's just thinking outside the box, just doing something a little bit creative, which, as you say, the planning game thing's a great idea if you know how to do it.
100%, yeah. And just for Ben's comment there, definitely check out the Developers Network Birmingham if you want to get involved in property development. I mean, there is people there too that talk about HMOs and buy-to-lets, but it is more development focused. But we welcome everybody with open arms.
Yeah. I mean, look, I think I've seen every one of us. I think the only person I've not met at an event so far is probably you, Amy. But anyone else want to chime in on any particular events that they think are worth mentioning? Doesn't necessarily need to be your own, or maybe not even one that you've been to, but I know I've been to quite a few, and I agree that there's a lot that are quite samey and boring. Anyone that's done or been to any decent events they can recommend to people, other than obviously the Property Developers Network in Birmingham?
Yeah, there is.
Oh, sorry.
Sorry, you go first.
So I went to the Shah Hussain property meet. I've been to that a couple of times now, and that's really good, actually. I've met quite a few contacts there, investors, people just generally are there to learn as well. But the main thing for me is that it has really good speakers on, which have built up, generally they built up their own business and then gone into property, and there's a lot to learn from the likes of, I think he had Neville Wright there. There's another guy last time, he was really good. So yeah, check that one out, the Shah Hussain. He's also on YouTube as well, so you may want to go and watch some of his videos. That's not a plug for him, by the way.
I was going to say, how much is he paying you?
No, his events are good. I've been asked to go to PIN, Property Investors Network, but I haven't made it to that one, and it sounds like I better get my bum to the Property Developers Network pretty soon, otherwise I won't be on it longer.
Absolutely, yeah. You're not coming on the next one unless you come along. Paul, you were going to mention something?
Sorry, yeah. Small plug, but the place where I'm working at the moment, we're doing the HMO Flip Consultancy. It's a 2-day event on the 12th or the 13th of May, and that's going to be in Shirley. So that's basically where you're going to be learning a lot
of the road from me. Awesome.
It is, man. Hope to see you there.
Definitely grab a beer. 100%.
Yeah. Oh, absolutely. And that's for anybody who goes. It is a paid event, but literally contact me and I can get you a pretty damn good deal. But essentially, there's all sorts.
Does the deal end in a 7?
It doesn't. None of them do. But no, it's with true HMO experts. You're going to be meeting some of my clients there as well, which is pretty sound.
I have realised that this is taking on like the cycle of chatting about stuff and at the end selling something. So that isn't what we had planned, is it? Run to the back quickly, and you'll get a deal.
Not one of those. No, it's a series of good guest speakers and true industry experts, which is superb. But it's really sort of following the cycle as to why people are investing heavily into HMOs and apartment blocks at the moment, and then what they're doing with them afterwards. So. Yeah, sorry. Also, I used to go to PIN networking events in Manchester. That was pretty sound.
Awesome. Radhika, I know you've spoken at a few events, haven't you? Any that you can recommend?
So I go to Tej and James's event. I have no idea what it's called.
It's called the property event. You can't forget it.
I have a t-shirt as well. I'm also going to Ranjan Bhattacharya's one at Baker Street on a Wednesday. I think it's the third Wednesday of the month. I have no idea. Just if you follow me on Instagram, you'll know what events I go to. But
I'm going to try and get to that one as well, Radhika. So we'll have to grab a drink beforehand.
I can't remember what date it is. I don't know if I'm away or not, but
we'll figure it out. To be honest, all these people are pretty well known anyway.
Yeah, anyone that's going to an event, like if you're choosing, I would just pick a couple that you go to, because it can be quite overwhelming and you won't actually like action the stuff that you actually want to get done, because it's like constantly overwhelmed with so many events to go to. So I would just maybe pick like a couple, like 2 or 3 in the month. Pick out what speakers you want, what you want to get out of that, and kind of just stick to that. Otherwise, it can be overwhelming going to like every single one and not taking any action. Basically.
Yeah, I couldn't agree more. I think that for me, it's about trying to maybe like go to a load, like maybe spend 1 or 2 months like testing the water and going to as many as you can, and you'll quickly see like the ones that you actually enjoyed and the ones you didn't, and then just become a regular at those particular events. That would be my sort of advice to people that are looking to go to these events. But I'm wary that we're kind of coming to the end of our hour, believe it or not. Does anyone want to sort of chime in with any kind of comments in terms of I want to get some predictions here now, guys. Everyone's telling us that the property market is going to crash, right? So should we do a quick round of predictions as to when the property market is potentially going to crash, if it does at all, and what are the reasons going to be behind that crash happening? Anyone want brave enough to jump in with a prediction early doors?
Yeah.
There he is, Mr. OnlyFans.
I knew Paul was going to go first.
All right, I'm just looking at the calendar. Crash in 2024. No reason why. Crash in 2024. I think realistically, it's because, as I mentioned before, supply and demand, fear and greed. You know, it's like, give it another 2 years. We've already had 2 years of what I would class as hyper growth, but it might not be, because we may have had a period like this back before I was born. I don't know. But it's not looking like it's going to slow down. It's going to be if it's based on the public, we're not the ones driving the market at the moment. Like, you know, normal people aren't driving the market. It is actually the investors who are driving the market. And there's just so much more investment going to be coming in. I just don't see a crash coming realistically. If there is going to be a crash, it will be midway through 2024. But it's very, very unlikely. It might be the case. Personally, I think that the UK is going to become like Germany, where nobody buys their own house. They're going to rent. Personally, I think that's where the UK is going. So if you are in investment, get involved with your investment now. You know, if you're looking to buy for yourself, probably don't.
Anyone got any difference to 2024?
I'm gonna side with sort of what Ben has just said. I think it's maybe 2024, even 2025, 2026, and my reasoning for that is as well. There's something called neutrality. It's something to do with nitrates. Now, I'm still reading up about it myself. Now, that has caused a lot of planning applications to be denied or put on hold, and I'm talking in the tens of thousands of them, right? So that's put a hold on development in a lot in the northeast and a lot down south. You know, Google it, and that will effectively cause less homes to be built, creating a lot more demand, and that's why I can't see there being a crash. How can there be a crash with more demand? So it's really difficult to say, but I'm thinking, it's going to be a few more years down the line for sure. For now,
Radhika, any advances on any of the other years that we've discussed?
Yeah, I don't think it's happening anytime soon. I reckon it will be like a couple of years, maybe beyond kind of 25, 26, just because of like where everything is happening at the moment with the war, with the energy prices. Like there's so much going on out there. I know I was literally just watching the news literally just before I jumped on here, and they were talking about how like the local mayors are promising like more housing, but whether that's affordable or not. So there's always going to be a need for housings, which is why I don't kind of see it dropping anytime soon.
Amy, any thoughts on the imminent property market crash?
Just to second what everybody else has said, really, based on supply and demand, if we go back to basic principles, I just can't see that there being a crash anytime soon. So yeah, based on that, I mean, at best I'd push it out another 3 to 4 years. But yeah, down to the basic principles, supply and demand, I can't see a crash happening anytime soon. So
Cool. Well, I'll give my 2p's worth, and then we'll sort of start wrapping up. Now, I think that there's an additional driver to the property market as well as supply and demand, and has an influence on supply and demand. And we only have to go back about 12, 13 years to see the last time this had such an influence on our market. That's the availability of credit. And at the moment, the availability of credit is very, very high. We've got more liquidity in our market than we ever have done in our recorded history, I believe. We have over £1 trillion worth of available institutional money at the moment, which is insane. When that money is available, it means people can get that money to buy property with. When that starts to dry up, that's when I think we're going to start seeing a change. And it's the reason I brought on Mr. Changa's message on here, which is all about what do we mean by a crash? Do we just mean property prices dropping? I agree that I don't think we're going to see some massive, huge crash. I think it's just going to be a case of property prices dropping because the demand may well drop a little bit, because as we know, the vast majority of our market in terms of buyers are residential buyers. And if it's more difficult for them to get a residential mortgage, they will not move, or they will look for something slightly different. But the number of people actually looking to buy will start to drop. Not so that we're creating, we don't have this supply and demand deficit. I don't think that's ever going to be going away. But I think it will drop enough to stop this mad market that we're on. And I've predicted, I've gone on record and said, I think over the next 4 Monetary Policy Committee meetings, which is the Bank of England meetings, I think 2 out of the next 4 are going to result in a rise. And I think potentially even one more rise could be just that little bit much more than we need to create a bit of an issue when it comes to affordability for residential mortgages. And that could be just that straw that breaks the camel's back in terms of changing our market slightly. So that's my thoughts on it anyway. But look, guys, if anyone wants any sort of last minute screen time, just stick your hand up, but otherwise we'll just start saying goodbye, I guess. Thanks ever so much for everyone for coming along and joining us. Thanks for everyone for watching. Cheers, Amy, Paul, Shane, Radhika. Like, honestly, I've had loads of fun, and we've been on here 1 hour and 3 minutes, and it feels like
it's gone so quick.
It's been awesome. We'll have to make it an annual event on the 4th of May every year. We'll do this. Maybe we'll do it in person next time. But
just do it for every event. Like, we'll do one for Pancake Day. We'll do one for St. Patrick's Day.
I'm happy to do it if you guys are happy to do it. more than happy to.
Let's just stick some dates in and we'll figure it out.
Yeah. Well, I think we'll do it again. But just to respond to what Ben said as well, I'm pretty sure, Ben, if you contact any of us on social media, we're all pretty messageable. Just reach out if you got any questions. We're all happy to help, and spread our knowledge. But yeah,
absolutely.
We'll point you in the right direction.
We will indeed. But guys, should we just do a little wave and say goodbye. Thanks ever so much, guys. And yeah, we'll see you all again.
There's a Star Trek pose.
That's Star Trek. That's the wrong
I know.
thing. Also, I did
doing
actually
it.
I had a Star Wars T-shirt on. Just I did make an effort. Just as an FYI. Yeah, we'll get it all completely wrong. Nanu.
Thou shall not pass.
Right. See you all later, guys.
Right, see you
Thanks so
later.
much
See
for
you, everyone.
joining.
Take care.
See you later, guys.